Trent Brandon Rogers, Bradshaw Rogers Financial Partners, and Mind Your Money. Thank you for joining us for this market update. Today is August the 1st, 2023. A couple things we're going to talk about today, Brandon. We're going to talk about the rates, obviously. We see the Fed's continuing to be aggressive. But then secondly, we're going to talk about some statistics. We've had some questions from clients of why we're being defensive, and then also clients saying, hey, I want to be more defensive in this current environment. They don't feel good about the overall economy itself, which is understandable, but we'll talk a little bit about that. And then ultimately, what are we doing with the portfolios?
Yeah.
All right, let's jump right in. Brandon, touch on a couple metrics that we need to discuss in regards to recession and then potentially some other changes that are coming.
Yeah, so as Trent mentioned earlier, we had that Fed meeting last week, and it was as scheduled. The Fed is being very plain and clear this whole time, and they did increase rates by another quarter point. So in that 5.5 target range is where they're at right now. Again, most aggressive rate hike in history. So they're really pulling out all the stops to try to get this inflation under control. And again, they've been very clear about that. So there's still a potential for that soft landing that they're gunning for, as long as inflation continues to come down, which it has. Again, back off of its highs, and say in the 9% range last July to in the 3 range currently as of the latest inflation numbers. So
which is pretty significant.
Yeah, that's massive.
Pretty significant. So they're doing a fairly good job, but we got to keep our eye on that.
Got to keep our eye on it. If again, they'll keep an eye on it as well. Again, they're being very transparent, so there's really no massive surprises to the market. So that's a very positive thing.
Okay. Well, let's talk a little bit about the data of what we're looking at and why we're still maintaining some defensive approaches. Right. You'll talk a little bit about the portfolio here in a minute. But one of the primary indicators that we look at is, of course, Warren Buffett's favorite indicator. It's called the Buffett Indicator. But basically what it looks at is the total market capitalization. What is the market worth? And then they divide it by actual GDP, which is the growth rate of our economy itself. When that number gets above 100%, as far as the ratio, then you get a little concerned. And right now, in the current environment that we've had with the rally that we've seen in June and July, we're at 182%. 182%. Put that in perspective. If you go back to the tech bubble of the 2000 to 2002 time frame, and we know how that ended, that ratio was 105%. So this is another reason why we've got to be very, very defensive, protected, manage risk really well, because this can change on a dime. So we're going to continue to follow that. The second data point that we're looking at is we look at the liquidity that came into the system. That really drives markets because that money flows into the market and, of course, produces positive results like we've seen over the last 4 years. But the COVID refunds, the PPP loans that many corporations qualified for, and then now the ERC, employment retention credits that employers are qualifying for. All that money is coming in, all that money is being spent in the economy, and it's causing good things to happen in the near term. But it's projected that money is going to roll out or end by the end of the year, which means liquidity is going to dry up. And if the Fed continues, like you were saying, with interest rates and continuing to increase them, it's only going to tighten the supply even more. Think about this. Rates have gone up so much. If you have a mortgage that's 2.5%, 3%, and you want to purchase a new house, and yet you've got to get a new mortgage for 7 to 8%, you're going to think twice before you do that. Yeah. And that's a large part of our economy that drives a lot of movement of money in the system. So again, focus on that. Make sure you're prepared for it. If you got any questions, let us know. Brandon, touch on the portfolio and what we're doing now for the defensive approaches that we've got. We've got exposure to the NASDAQ. We've got exposure to the S&P 500. But what are we doing to layer in some defensive approaches there?
Yeah, so we're always going to have exposure to the overall market because, again, like you say, some data can be really bad, but the market continues to go up because of different various reasons, because there's a lot of different factors out there. But as far as the portfolio is concerned, we still, like I said, are in. We just do have about a third of it kind of hedged in a buffered type approach. So again, really all that is I was explaining, it's kind of a shock absorber if the market goes south. It's not, you're not immune from it. Everybody's going to feel it, but we're trying to minimize it as much as possible. So until we're totally out of the woods here, in a potential recession looming, say maybe first of next year, we'll see. We'll just continue to follow the data, and that's what's going to drive our decisions.
Well, and again, like you said, it continues to drive a lot of questions from clients to us. When you look at the NASDAQ, and 60% of the companies in the NASDAQ have negative earnings right now, but yet the NASDAQ's on fire this year.
It is.
So last year, very difficult, brutal year. This year, it's on fire, but yet 60% of the companies have negative earnings. That's a higher percentage than we had in the tech bubble. That's a higher percentage than what we had in the financial crisis. So the numbers are on the table. It just does not explain what's going on right now. And we also listen to research reports from Ray Dalio and Stanley Druckenmiller, who are probably one of the best well-known historical hedge fund managers out there. And if you look at that, they basically say that the economy and the market itself is in chaos. They can't explain it. And that's where I went back and we discussed it. We're having the same difficulties. We look at the data, it doesn't justify what the market's doing, but the market's doing it.
It is.
Yeah.
So again, we'll always keep you up to date and posted and what we're thinking and what we're doing inside the accounts. But again, any questions whatsoever, just let us know. But thanks for joining us. It's Brandon Rogers and Trent Bradshaw with Mind Your Money. Take care.